Hey there! Today I'm going to be talking about another presenter I saw at the National Achievers Congress 2017. And that is Steve Sitkowski. Maybe he pronounces it Sitkowski or something like that. But anyway, he talks a lot about stocks and options, and I think there's some useful stuff that I can pass along to you. I want you to remember I am not endorsing anybody here, or supporting them, or saying they're right or wrong. I try to give my opinion about some of these things, but I'll reserve judgment to you as well on a lot of it. I merely want to pass along the good takeaways that I had from this presentation, and give them to you for however they can help you in your future investment or creating the life you want. This guy talks a lot about wealth and creating wealth for the future. So, without any further ado, let's get into what this guy was talking about, what I learned. Here he is, the man himself, Steve Sitkowski. Nice little picture there. Little intro for you. I'm going to be completely honest, I did not have a good quote for Mr. Sitkowski, but because I love them so much, I got to give you something. Not all classrooms have four walls, and I couldn't even find out who said that. Really off base on the quote this time, but I think this is relevant for us in this YouTube digital world. I hope you're learning something right now and in the next few minutes, just from the four corners of your computer screen. Let's look at some of the accomplishments of Steve Sitkowski. That way we get an idea of who we're talking about here. It's always good so that you can understand the credibility that you should, put on that. The weight that you should put on a teacher's words, how many grains of salt you should have with it. So Steve has spent apparently his entire life in the financial services industry, and he was a certified financial planner, first of all. It's very interesting, though. He said that didn't really mean all that much because you could, first of all, get that in a few months, and it really just meant that you had learned how to sell whatever mutual fund your company had. This is what he said. So this is why he went out on his own. It sounded like he was a little jaded about the industry, and people weren't really giving good advice, and maybe weren't even really qualified to be giving the advice they were. So that's why he wanted to go out on his own, create his own business, and help people actually get good returns. So after that, or maybe this was part of it, I don't know if he's currently either of these things, but at one point he was also a registered investment advisor. He ran his own stock brokerage, I guess that was down in Florida, and he was president of 2 financial planning organizations. He also hosted a nationally syndicated radio talk show, although I don't remember which one, and I didn't easily find out which one. I'll leave that for you to research if you're interested. And lastly, notable, I'll mention, he's the author of 2 books. One is called 30-Day Money Makeover, and one is called Trade Like the Pros. Okay, before I get into the big takeaways that I had, I want to be clear that stocks aren't my favorite investment. Neither are options. I've learned a lot from Robert Kiyosaki. I talk a lot about him. He's the author of Rich Dad, Poor Dad. And he talks about a few reasons that stocks, while they can be a good diversified investment, there are some reasons why they may not be that great. And I'm going to go over those just because I know you're curious. First of all, history does not necessarily predict the future. Just because the stock market has had a certain average return for however many years you want to list does not mean that that is going to continue. Now, chances are, maybe it will, but just like how home prices didn't continue to go up when that's what people thought the only thing they could do, in 2008 we saw what, frankly, a manipulative government and terrible regulations and bad incentives for people, basically, can do. And that crash caused a lot of lost money, a lot of heartache, a lot of pain for people. So there may be something similar in the near future as it relates to the stock market. I don't know how the government can continue printing money and propping up the stock market as it is. But we'll see. Maybe I'm wrong. Next, when you own a share in a company, you probably have a very small ownership of that overall company, right? That's what a stock share means. But you probably own a very tiny portion of the overall company, which means that you have no control over the underlying asset, which is the company. The company is going to succeed or fail based on probably management, the environment, government regulations. Again, there's all kinds of other factors, but the main thing to note here is that you are probably not one of them, unless you go to the stockholders meeting and are so vocal that you change everybody's mind. So diversification isn't a bad thing when you don't really control the underlying asset, and that's why investing in a wide variety of companies is, I think, common investment advice. So the other side of that, though, is if you can control something, maybe it's worth putting more eggs in that one basket. Lastly, stocks represent ownership in a company, as I said, and this is great, especially if the company does well. But there is no inherent value in the asset that you own, right? You own a piece of paper, or probably actually you just have digits on a screen in your Scottrade account that say you own a piece of a company. This is extremely unlikely that there would be a collapse of whatever institution, either the company or the institution you own this through. But the point being, if the you-know-what hits the fan, that piece of paper, those digits on the screen, might not be worth much if you were to compare it with something commonly used by Robert Kiyosaki like gold. And you could say gold doesn't have inherent value either. Well, it's tangible, it's shiny, it's easy for people to want and to use it as a medium, right? Okay, just another example. Now that we've gone over that, though, there are plenty of people who have become millionaires trading options, okay? And if you want to become one of those people, if you want to leverage the power of options, I want to explain exactly how they work, because I think they're very confusing in general, and it's because people do a terrible job of explaining. So I'm going to do a good job. Ready? What is an option? Here's the example I'm going to use for an option. I pay $1 for an option to buy a stock, let's say stock A, for $100 in a specific time frame. This means that I've already paid $1, but I don't own any stock yet. I just own the option, which would allow me to buy the stock for $100. With me so far? Okay. This investment will result in one of two outcomes, and we'll give very specific outcomes here. In the time frame that the option allows, that I paid for, if the stock value goes down to $90, I wouldn't exercise my option. Why would I want to buy the stock for $100 with my option when I could just buy the stock for $90 on the open market? Doesn't make any sense. So in this case, I would let my option expire, and I would lose my $1 investment because I paid that $1 for the option itself. The second thing that could happen in this example is, again, within the time frame, the stock goes up to $110. In this case, I would exercise my option, buy the stock for $100, and then turn around and sell it for $110, because that's the current value of it. In this case, I would make $10 less my original investment of $1, and I would actually have a $9 profit. I know I put 10 there, but got to take away the initial investment. So that'd be a $9 profit, okay? The only other big thing to know, and obviously the details of this can change, the time frame you're allowed to exercise the option in, the cost of it, the stock you're in, so many things can change. But this is the core concept of an option. And the only other big detail that I want you to be aware of is that there are two main kinds of options. One is a call option, and that gives you the right to buy a share. And one is a put option, and that gives you the right to sell a share. Again, at a specific price within a specific time frame. So in general, Steve says you want call options when the market's going up, and you want put options when the market's going down. Now, of course, it has to be specific to the actual stock that you're buying. But yeah, if you have a call option and the stock price goes up, you're going to exercise it and make money. If you have a put option and the stock price goes down, you're going to exercise it and make money. Okay? All right, so now let's get into kind of the specific takeaways that Steve shared during his presentation. 1, and this is something you've heard a million times. Diversification is key to creating long-term wealth. In general, this is a widely accepted piece of wisdom. In more specific cases, however, like I mentioned earlier, it may be wise to put a lot of eggs in one basket if you have control over it. Andrew Carnegie famously said, instead of, don't put all your eggs in one basket, he said, put all your eggs in one basket and then watch that basket. If you can focus your attention on the investment and you have a lot of control over it, in theory, it could be better than 10 scattered investments that you don't understand, that nobody's managing, that they're just sitting there. This is why I'm such a fan of people creating small businesses that they have control over. You have a business, you run it, like you determine if it does well or not. For the most part, there are always other factors. Okay, another takeaway. Since World War II, the average large stock has returned about 10% per year. First thing to note, inflation cuts into this. Second thing to note is that these indices, he says large stock, this is just a metric, I'm sure that was looked up, and these metrics get warped. Even the Dow Jones, the 100 companies or whatever, they change from time to time. And so if you follow the index, and a particular stock didn't do so well, so it gets removed from that index, and a stock doing better gets put in the index, how is that actually tracking the return overall of that set of stocks? It's not, is my point. So you got to be very careful when you pay attention to these metrics that people selling you stock stuff want you to know. The third takeaway. With options, direction doesn't matter. And what he's saying here is basically that you can make money with call options when the stock goes up, and you can make money with put options when the stock goes down. So no matter what the market's doing, there's always opportunity to make money with options. In fact, he said that sometimes he or his company, whatever, they buy both call options and put options on the same stock. I forget what he called this exactly. But if they're confident that the stock is going to move, maybe there's some huge event or something that's about to be released by the press, that there's a lot of turmoil over, who knows. If they're confident the stock is going to move a lot, but they're not confident in which direction, maybe buying both gives the opportunity to make money. And the reason being, the last point here, options create leverage. This means, in our previous example, if you invest $1 in an option, you could make $10 on the return. And if you bought 10 of those options, you could make $100, right? So it multiplies. There's leverage that you create with a small amount of money invested to create potentially large returns. And if it doesn't work out, you're just out the initial investment. Next, Steve had 3 takeaways that he called his, keys to success. In other words, if you have these, you'll be successful. The first one is a burning desire. Second one, specialized knowledge. And the third, the ability to act. So take these for what they are. They're a little intangible, but I mean, I agree with them. I can't really disagree. If you have the motivation, the knowledge, and the execution, you're going to accomplish whatever you set out to accomplish. So, good takeaways. Keys to success. Finally, Steve talked about how to pick a good stock. And these 6 takeaways will not just make you a picking genius. They are things you have to consider and understand, and they are a few factors mixed in with many. There is no silver bullet. However, these are the things that he shared, and I want to share them with you. First of all, the company's earnings are going up. That's a good thing in general. Its overall revenue is going up. Its dividends are going up, he said, is a good sign for a good stock. And this is actually very interesting because I remember, especially in the .com era, when a company started issuing dividends, that was seen as a catastrophic sign for the stock. It meant that the company couldn't figure out what to do with all their cash to make amazing reinvestments in the business that would, down the line, make the stock price go up 100 times. And instead, they were just giving out little dividends to its stock owners. But in general, he says that dividends going up, good sign for a stock. This next one is huge, I think. Insiders are buying. So if the president of the company, who's already drawing salary, bonuses, probably already owns a lot of the company to begin with, or let's say CEO or founder, whatever you want to say. If he thinks the most effective or useful place to put his money is buying back the stock of his company and owning more of it, that's a good sign, because he has inside information about how the company is doing, how it might do in the future. Okay? And you can find these are public documents. When a publicly traded company, when an insider, somebody who owns a significant portion of the company or has a important position, buys or sells stock, that is public information. Okay? Next, the overall company direction is positive. This is very vague. We could talk about this till we're blue in the face. But if you think the company is making decisions that are going to be good for it in the long run, obviously that is a good stock. And last, you can pay attention to moving averages. The specific example he used, is if the 15-day average of the stock is much higher than the 50-day average, that's an indicator that the stock price is moving up overall, it's doing well, and you should buy. All right, I hope all this stuff is super useful. Again, I've shared some of my opinions, but I reserve others, and you can have your own opinions as well. My goal here is to pass on what I'm learning from these speakers, and in this case, Mr. Sitkowski, and I hope it helps you at least understand options better. Maybe it'll help you with your overall future investments and wealth creation, and if I can help you with that, I'm a happy camper. Now, of course, if you decide that you want to invest in an asset you can control, my business is helping people become entrepreneurs. So that would be learning how to create your own business that you can control and watch that basket. In that case, you can head over, I guess I'll put a link below to my client application page, and you can get a free consultation there and everything, and we'll see if that's the right path for you. Otherwise, I can't wait to see you next time. I'm going to be sharing, I think, 3 more. I've already done 4 on this National Achievers Congress and all that I learned from the presenters there. So I look forward to seeing you next time.